I believe we got to a profitability index in the last class. So let's continue from there today. Before we start, do you all have any questions from capital budgeting from last week? Right, so let's move on to a profitability index. Now, profitability index is the ratio between the present value of future cash flows to initial investments. Right? The decision rule is to invest if profitability index is more than 1. So it's the present value of future cash flows divided by your initial investment. Let's do the profitability index for this. You end up with a profitability index of 1.19, which is more than 1. Therefore, you need to invest. the advantages and disadvantages of profitability index. Calculation is of course similar to NPV. Now you're looking at a ratio, so you can, size does not matter. It addresses the issue of size. Disadvantages, it is similar to NPV, so it's a little complicated, and all the complications with NPV also comes with it. And it doesn't give you an absolute number, it only gives a relative number, right? Not absolute, not in absolute terms, in relative terms your profit comes. Okay, so that's profitability index. Any questions? So let's go on to the next area, fixed income securities. Fixed income securities. What is fixed income security? Yeah, an investment. It is an investment that provides a return in the form of fixed periodic payments. So it's fixed. The return you get is fixed, and it comes periodically. And the eventual return of principal at its maturity. So you get your investment back when it matures. Can be like the basic example is a fixed deposit. If you had put that you want to withdraw quarterly interest, every 3 months you will get your interest. Also, when it matures, you get your capital back. Example, 5% fixed rate government bond, where $1,000 is invested. In this case, let's say this is a 2-year bond. A 2-year bond. $1,000 invested. 5% fixed rate government bond where $1,000 is invested. So $1,000 has been invested. Rate is 5%, meaning every year it will give you a coupon of 50. Right? So every year you get a cash flow of 50. $50 annually. So this will pay you so this bond, a 2-year bond, which pays 5% annual coupon interest, will pay you annually a coupon of $50. And when it matures, I repeat, it will pay you $1,000 at maturity. So this bond matures in 2 years. When it matures, it will give you $1,000. Not every year, mind you. The face value comes only at maturity, not every year. So you won't get $1,000 in the first year, only when it matures, right? So your total cash flows will be $50 in year 1, $1,050 in year 2. Right. Why would you invest in fixed income securities? Now, before we go there, just look at this instrument and compare it with, say, stocks, with shares. Right now, in the case of a bond, it pays a periodic payment and has a maturity. But if you take shares, there is no guarantee that every year you will keep getting coupon interest or dividends. No guarantee that every year it will pay dividends. And equity does not have maturity. It will not mature. And no maturity. And there is no guarantee that every year it will pay dividends. Unlike a bond. So why do you invest in fixed income? To diversify. So you need to diversify, meaning you need to reduce your risk without reducing returns. The only way to do it is to diversify. It helps reduce volatility in the portfolio, different maturities, different risk exposures, then to have stable income streams. Income to be streamlined, to have a stable source of income. Steady income. Lower risk in investing in bonds issued by governments. By the governments, lower risk meaning government bonds denominated in local currency carries no default risk, right? So the government, if you invest in government bonds denominated in local currency, it has no default risk. There is no default risk. For example, if you buy Sri Lankan rupee denominated treasury bonds and you are a Sri Lankan, you are living in Sri Lanka, then you have no default risk. It's guaranteed that the government will settle. Default will not happen. But if you invest in bonds issued by Sri Lanka but denominated in dollars, then you can be exposed to default risk. And that's called sovereign risk. Because although the government will definitely pay its rupee obligations, if the government runs short of dollars, they might be unable to settle their dollar obligations. Right? So foreign currency denominated bonds issued by a government may not be default risk free. Can be exposed to default risk. Foreign currency denominated bonds. Right? So if a government issues bonds in its own currency, it carries no default risk. Tax advantages. Investing in government bonds can have tax benefits. Right? Because the income that you generate from treasury bonds can be exempted from income tax. Not right now, but in some instances, that relief is allowed. So you can claim tax, withholding tax. Right, not right now though. Then the risks. Treasuries do not have default risk, unlike corporate debt, since governments have been vested with the power to print money. And so the government bonds will carry no default risk, but corporate debt can carry default risk. Because although governments can print money, corporates are not allowed to print money. However, they are exposed to interest rate and liquidity risk. Right? So if you, for example, invest in a 30-year bond at a fixed rate of, let's say, 10%, you invest in a 30-year bond at a rate of 10%, and the interest rates go up, then you will lose. You will have opportunity losses. You will have invested at higher rates, but you're fixed for the next 30 years at a rate of 10%. Liquidity risk. Now, sometimes this 30-year bond might not have too many takers. But, maybe only insurance companies or provident funds might be interested. There might not be any active investors. So they can be exposed to interest rate risk and liquidity risk. If a government issues securities that are not denominated in its local currency, there is a possibility of default, which is dependent on the sovereign risk of the country. If the government has issued debt which is denominated in a foreign currency, there can be default. There can be. It has happened now. Examples I can quote are Argentina. There was a debt default by Argentina not too long ago, and also Greece. These countries have defaulted on debt. Now, in the case of Greece, interesting case study because Argentina defaulted on dollar-denominated debt, whereas Greece defaulted on euro debt. Right? So their local currency is also the euro, but still they defaulted. Why? Because although their local currency is euro, they have no power vested with them to print euro. Because printing euro is done by the European Central Bank, not by Greece. Greece alone cannot decide whether to print or not. Then to reduce settlement risk, DVP-RVP has been introduced. DVP-RVP is delivery versus payment and receipt versus payment. That means if you do a bond transaction or bill transaction, the settlement happens simultaneously. However, counterparties can still default if they fail to deliver the security or the settlement amount. Right. Now, determinants of market interest rates, market forces, the real risk-free rate. Nominal rate is equal to real rate plus inflation. This is an equation which all of you are familiar with. So whenever real rates go up, nominal rate also usually goes up. Right? When inflation also goes up, usually nominal rates can go up. But usually when inflation goes up, what happens is the real rate or the real return will drop because nominal rates are usually fixed. Inflation going up will result in the real rate dropping. Then the inflation premium, default risk premiums, liquidity risk premium, and maturity risk premium. When inflation is expected to go up, you might expect nominal rates to increase. Then when default rates also expected to go up, you might expect interest rates to go up. Liquidity risk. When liquidity is concerned, if you cannot sell it, you might charge a liquidity premium. Maturity risk premium, when the term to maturity is high, again you might expect interest rates to go up. Why do governments issue debt? To meet budget deficits, because governments will have inflows and outflows. The inflows will come in terms of tax collections mainly, and other things like fines, the investments will also bring some inflows. Outflows will come on infrastructure development, the capital, the government expenditure, right? Maybe the current expenditure or capital expenditure. There will be inflows and outflows for the government. If there is a deficit, then the government will have to bridge the deficit. One way is to issue treasury bonds or bills, so to meet budget deficits. Then to control money supply, because if there's too much of money circulating in the economy, and if I am the central bank, what I can do is I will sell some of the treasury bonds to the market. Right? When I sell treasury bonds to market, the cash that is available in the market will get absorbed by the central bank. Likewise, if the market is short of liquidity, the central bank can buy some of the treasury bills and bonds from the market. And the central bank buys, it will release rupees into the market. So by doing that, the central bank can control money supply. Then to control interest rates, right? When money supply goes up, usually interest rates goes down, and when money supply is low, interest rates will go up usually. Right? So that can also be done using debt securities. In primary and secondary markets, government securities are initially issued at a primary auction. The debt securities are initially issued at a primary auction. It's like, in fact, the best example I can quote is it's like getting married. When you get married for the first time, then you're trading in the primary market. When you get married for the second and third time, then it's like secondary market. Right? So same thing applies for government bonds. When they issued for the first time, they are issued in the primary market. Subsequent trading happens in the secondary market. Potential investors bid through primary dealers, who in turn submit the competitive bids electronically to central bank. central bank will accept the lowest bid. Bill auctions are usually held on Wednesdays, 2 working days before the last day of the week, and settlement occurs on Friday. Right? So every Wednesday there is a bill auction, and the settlement happens 2 days after that on the spot date, which is Friday. Bond auctions are settled on the 1st and the 15th of a month, and auctions are held usually 2 working days before the settlement date. Government securities subsequently trade in secondary market, which is an over-the-counter market. Now, let's do an example of a treasury bill auction. Bond auction also happens in the same day. Right, so every Wednesday, the central bank will announce, usually it's before that, they give about 2-3 days notice. They will say that they have a borrowing requirement of, let's assume, 5 billion rupees. The government will be borrowing 5 billion rupees. They usually mention the tenors, like 91 days, 182 days, and 364 days. So this is, in other words, 13 weeks, 26 weeks, and 52 weeks. 13 weeks is also called 3 months, 6 months, and 12 months. Three months, 6 months, and 12 months. So they might say government will borrow 2 billion, 91 days, and maybe 3 billion, 192 days, and 5 billion, 364 days. Right. So this is the auction announcement. It will come like this. So let's take, for example, what happens on the 5 billion, the 364 days. Right. So let's say there are a few banks, A, B, C, D, E, and F. So A bid A amount and the rate. Say A bids for 1 billion at let's say 4.95%. Right. B will bid for 2 billion at 4.98%. C will bid for 1 billion at 5%. D will bid for 3 billion at, let's say, 5.05%. E might bid for 2 billion at 5.01%. And F might bid for 2 billion at let's say 5%. Right. So this is how the auction is held. All submitted electronically. They will give the amounts they are bidding for and the rate. Now the total bids that have been received will be 11 billion. Right. 11 billion bids received. Whereas the auction size is 5 billion, 364 days, 5 billion. So this has been oversubscribed. Oversubscribed. Central Bank only wants to borrow 5 billion. They have received bids of 11 billion. Now the next task is to identify how the bids will be accepted. Which one do you think will get accepted first? Which bid will get accepted first? D. Right, Dinesh. Now, who is the borrower in this case? Who is the borrower? Yeah, central bank is the borrower, right? Central bank is the borrower, and when central bank is or anyone is borrowing, they will try to minimize the cost. Now, when central bank is borrowing, they will want to minimize the cost. That means they will want to borrow at the lowest possible rates. Okay. So which one will get accepted first? It will be A. Yeah. Fully accepted. This will be accepted in full. They'll take 1 billion and 4.95. And then yeah, the second lowest is 498. So 2 billion accepted in full. What comes next? And so far they have got 3 billion. Total is 5, another 2 billion to go. Which one is next? The next lowest rate is 5%, which is coming from C and also F. Right, C and F. 5 billion. For convenience, I will just change this bids received to 3 billion. Or maybe 3 billion. Otherwise, I'll be jumping up and down with decimals. Right. So the third lowest is 5%, which is coming from F as well as from C, isn't it? Then the total amount, C is bidding for 1, F is bidding for 3. So we have got 4 billion coming at 5%. 4 billion at 5%. Central bank has got 4 billion at 5%. They only need to accept 2 billion. Only 50% of the 4 billion will be accepted. 50%, right? Meaning this one 1.5 billion accepted. Here, 50% of 3, 1.5 billion accepted. So that gives the 5 billion, which means this will be rejected. It's also rejected because total of 5 billion has been accepted. All the other bids rejected. Right. Now, if you look at the cost, you have got 1 billion at 4.95%. 2 billion at 4.98%. And another 2 billion at 5%. Meaning a total of 5 billion has been accepted at 4.95. The weighted average cost. Will be 4.98%. The 1 year weighted average at this option will be 4.98%. The central bank will say they accepted a total of 5 billion out of 12 billion bids at a weighted average of 4.98%. So this is how a treasury bill auction will be conducted. Only thing, it will not be a manual thing, it is an electronic thing. Right, so any questions up to now? No questions, let's move on. By the way, is this clear? Did you all understand how an auction takes place? All right. Then security identification. Security identification. How do you identify securities? How do you identify people? Using the NIC numbers. Right. So likewise, even government securities, especially bills, bonds, will also have something like an NIC number. It's called an ISIN number, International Security Identification Number. Right. All government securities will have this ISIN number, which is a unique number, and you can identify the security in no matter where you are. From any part of the world, you can identify which country has issued it, what is the maturity, and what tenor. Right. So treasury bills and bonds. Let's see how it goes. The first example is LKA 36414E097. So I'll write it down. Now I'm going to break it up. LKA 36414E097. Right. The first two letters, LK, means Sri Lanka. So if it was US, it would have been US. A means treasury bill. If it was bond, it would have been B. 364 is the tenor that it was originally issued for. Now this is a 364-day treasury bill when it was originally issued. 14 is the year that it matures, 2014. E is the month. And so it's very important that you know your alphabet when you're doing treasury bills and bonds. And because each month is denoted by a letter. And you need to know only up to L, because L is the 12th letter. There are only 12 months for the year, and L is the 12th letter of the alphabet, right? So study your alphabet until L. Don't need to study beyond that. 09 is the maturity date. This bill, matures on 9th May 2014. 7 is called the check digit. The treasury bond identification. Very similar. Write the example, same example that I have quoted. It is LKB 005 15G 159. Again, I'll break this up. LK once again means Sri Lanka. B stands for bond, right? A was bill, B is bond. 005 means when this bond was originally issued, it was issued for 5 years. 15 is 2015. G is A, B, C, D, E, F, G. At A, B, C, D, E, F, G, there is the seventh month. 15th, 15 is the 15th day of the month. 9 is a check digit, right? So this is 15 July 2015 maturity. That means it will have been issued 15 July 2010, 5 years before that. Okay, so based on this, I will give a small exercise. Give me the ISIN of a treasury bond, a Sri Lankan treasury bond that was issued for 30 years, maturing on 1st January 2040. So let's say a 30-year treasury bond issued by Sri Lanka, maturing on 1st October 2040. Check digit is 5. Right? Give me the IC. So the question. Okay, the ISIN of Sri Lankan bond, 40-year Sri Lankan bond, maturing on 1st October 2040. 30-year Sri Lankan bond, maturing on 1st October 2040. Right? So it's LK bond, therefore it is B. 40-year bond 040, maturing in 2040. October is A, B, C, D, E, F, G, H, I, J. Right? It's the 10th month. That is J. 01. Check digit I said was 5. Yeah. Dinesh, I hope it's clear. All right. Then bond terminology. Although these terms sound complicated, believe me, they are very, very easy. Right? Just basics. Only thing you have fancy term. Bond terminology. Issuer means the borrower. Par value, the value that you get when it matures. Coupon is the periodic payment. Price is how much you have to pay for the bond. There are two kinds of prices, clean price and dirty price. And the price can trade at a premium or at a discount. Then the term to maturity, when is this bond maturing? Due to maturity, what is your return if you hold it until it matures? Accrued interest. How much of interest gets accrued? How much of coupon interest gets accrued? Right? That's basically the dirty price is equal to accrued interest plus clean price. Bond with options, callable bonds, puttable bonds, and the yield curve. The issuer is the entity that promises to make the payment. In other words, it is the borrower. The issuer is the borrower, in other words. They will agree to pay at specified dates consisting of interest, coupon interest, and principal. The amount borrowed at maturity. Right. So the issuer is, in other words, the borrower. The borrower will agree to pay the interest amount periodically as well as the principal when it matures. Types of issuers are governments, central governments, then related agencies of governments, municipal governments. It's like maybe the Colombo Municipal Council can issue their own bonds, something like that. But it's not freely available, not widely popular in Sri Lanka, but in the US, very popular. Right? Municipals can issue their own bonds. Corporates and supranational governments. Supranational governments are governments of a particular zone, right? Like the Eurozone. So they can get together and issue bonds. There may be organizations like OPEC can issue bonds. And that's called supranational. Par value is the amount the issuer agrees to repay the bondholder at or by the maturity date. It is also referred to as the face value. A par value is the value that you get when a bond matures. It's also called the face value. So let me draw this in a small diagram. Let's once again say this is a 2-year bond issued by the government of Sri Lanka. Coupon is 10%. Face value of 100. Right. So the government of Sri Lanka is the issuer. %10% coupon, meaning coupon amount is 10. Every year you get coupons of 10. Face value is the value that you get when it matures, right? Or the par value. Right? Par value can be any value that you want. Coupon is the interest rate stated on the bond when it is issued. Right? It's the interest rate that is mentioned on the bond, on the face of the bond. It's called the coupon. It is a rate the issuer agrees to pay annually. It is called coupon. Holders used to receive interest by stripping off coupons and redeeming them. Now, in the good old days, these bonds had a piece of paper. They were in a piece of paper. So then, every 6 months, once in 6 months, you'll have to give like a coupon, right? Tear off the coupon, pay it off, and give it to the central bank or the issuer, and they will pay you the interest. So that's how the coupon worked. Right? And it was manual. Now it is all electronic. The coupon is the coupon rate equal par value. If you look at this example, 4.5%, 1/1/2010 has a par value of 100. So the coupon is 4.5% into 100. In this case, $4.5. Then you can have certain bonds which carry zero interest, zero coupons, no coupon at all. If that is the case, if the coupon is zero, then your coupon payments become zero. Right? So your only cash flow is the face value. Debt securities that doesn't pay interest. They're traded at a deep discount and redeemed for its full face value at maturity. Right? Now, what does that mean? Cash flow. Look at the cash flows. Here it is 0, and here you have 100. So no further cash flows. There's only one cash flow, which is your face value to get at maturity. Now, if you're investing, let's say at this point, right? You're investing today. That's why it is a minus sign, because you're making an investment. Then this investment, which is going at 10%, your investment should be the present value of your cash flow, isn't it? Remember, present value is the future value over 1 plus r to the power n. Right? So future value in this case is 100 over 1 plus r is 10% power 2. In other words, price of this bond is 82.64. simple present value calculation. So look at the face value and the price of this bond. Face value is more than the price. Face value is more than the price. It is called a discount bond. Okay. So in this case, what you do is you invest 82.64 today in a zero coupon bond. That your return will be 10% if you get the face value of 100 at maturity in 2 years. Right. So any questions on this? No questions? Right. It's called a zero coupon bond. If the bond carries no coupons, it is called a zero coupon bond. Right. This is very obvious. Right? It was a simple present value calculation. Right. Now, what if I take a small change? What if I add a coupon to this? Say 10% coupon. Let's say this carries a coupon of 10. 10% coupon, so you get every year coupons of 10. Meaning your total cash flow will be 10 the first year, second year 110. Right? This is your investment. First year you get 10, second year 110. Now how do you calculate the present value? Same process, the same discounting process, right? You have two cash flows, discount them to today's terms, and you get the price of this bond, right? So let's say that's how you work it out, right? You have to just simply discount it. I have not introduced you the concept of yield, so we'll get to that and then do the working. Okay, so it's just a matter of discounting the cash flows, what you have already learned. So coupon bond is a debt obligation with coupons attached, like what we just discussed. Coupon bond. Zero coupon bond is also like coupon bond. The only thing is zero. The coupon you get is zero. Then the price of a bond is the present value of future cash flows received by the bondholder. Present value of future cash flows received by the bondholder. It's called the price of a bond. Cash flows are interest payments at the end of each period plus the face value received at maturity, right? So these are the cash flows. These are the only cash flows that you receive from the bond, the coupon and the maturity face value. Cash flows discounted at the required rate of return. Cash flows need to be discounted at the required rate of return, which is the yield. So let's try these examples. First question, a bond that matures in 6 years has a par value of 1,000, annual coupon payments of 80 and market interest rate of 9%. What is its price? So it is a 6-year bond. Right, so this is a simple net present value calculation. Net present value is nothing but the price. Annual coupon payments of 80. Par value 1,000, so at maturity you get 1,080. 80 plus 1,000. Is 1,080. Right, 1,080 monthly. Then it said that the market interest rate is 9%. So this market interest rate means the discount rate. Or in other words, it's also called the yield. That is the return that you actually get from this investment. The yield, discount rate. The discounting factor at 9%. So do you get 955.138? Do we all get 955? All right. Let's move on to question number 2. Before you move on to question number 2, now the coupon of this bond is 80. This bond has a coupon of 80. Right? So that means the coupon rate. Coupon rate is 80%. There's the 8% coupon, and the yield is 9%. You might later on notice that when the yield is more than the coupon, the bond is trading below face value. Because face value is 1,000, the price of this bond is 955. Right? So yield is more than the coupon. This bond is trading at a price which is less than the face value. It's called at a discount. That is why earlier we said zero coupon bonds trade at a deep discount. We mentioned in this slide, zero coupon bonds trade at a deep discount because zero coupon bonds, the coupon is zero, meaning whichever way you look at it, the yield will always be higher than the coupon because coupon is always zero. Right? The yield is higher than coupon, it trades at a discount. So zero coupon bonds for that reason will always trade at a discount. Question number 2. The bond has a 15-year maturity. 10% annual coupon, $1,000 par value. Required rate of return or yield to maturity on the bond is 10%. Given its risk, maturity, liquidity, and other rates in the economy, what is the fair value for the bond? For the market price of this bond? Right? Says 15-year, but let's cut it short. We'll make it 5-year. Convenience, let's say it's 5-year maturity, not 15, but 5 years. Because 15 years will take a whole lot of calculations. And if you know to do 5 years, then you know to do 15 also. In the best interest of time, let's cut it down to 5 years. Right? So it's a 5-year bond. 10% annual coupon, $1,000 par value. Cash flows. 10% annual coupon means on $1,000. Every year you get a coupon of 100. And at maturity you get the coupon of 100 plus the par value, so it's 1,100. Required rate of return or yield to maturity on the bond is 10%. Discounting factor at 10%. So do you get a price close to 1,000? you get a price of 1,000. Yeah, 99.98. Good enough. Right, all that is because you're cutting off the decimals. Right, so you get something close to 1,000. Okay, now look at the face value and the price of this bond. Both are 1,000, isn't it? Face value 1,000, price of the 1,000. Then what about the coupons? Coupon is 10%. 10% coupon. Yield is also 10%. Right? So if yield is equal to the coupon, then the price is equal to face value. Right? If yield is more than the coupon, the price is less than the face value. But if yield is equal to coupon, price is equal to face value. Okay, that is the learning behind it. So let's try a third example. Third example, the same thing, 5-year bond. Let's assume the coupon is 12%. What happens when the coupon is 12%? Shall we calculate the price? Yield is the same, 10%. Let's calculate the price when the coupon is 12%. do you also get 1075.78? Okay. Right. Now again, let's observe the coupon. In this case, 12%. Yield is 10%, right? So yield is less than the coupon. If yield is less than the coupon, the price is more than the face value. Right? Price 1075, face value 1000. So if yield is less than the coupon, price is more than face value. Okay. So to summarize, if yield is more than the coupon, price less than the face value. This is called a discount. Then if yield is equal to coupon, price equals face value. Call this par. And if the yield less than the coupon, price more than face value, it's called a premium. Okay. So you all need to remember this relationship. Clear? Any questions? Right. So the formula to calculate bond price. It's a very simple equation. What we learned in grade 2. So you need to memorize this. Right. And don't panic. You don't have to. And I was only pulling your leg. You don't need to memorize this. Impossible to memorize unless you have a photographic mind. Right. So the bond price formula. First one is the coupon divided by the face value, which is like an interest rate. So there are two halves, two portions of it, which is separated by the plus sign in the middle. Now, if you look at it carefully, the first part of it, right, is like discounting the coupons. It is actually like the annuity formula. If you all could remember the annuity formula, this is similar to that, the present value of an annuity. Right? Remember, this bond price is, in other words, the present value of the cash flows. Whereas the last term, m divided by 1 plus 1 over f, is like discounting the face value of the bond by the yield. Right? So it's the present value of the annuity given by the coupon payments plus the yield being discounted at, sorry, plus the face value being discounted at the yield. Right? Yeah. So any questions up to now? Okay. So the if you look at this table, it gives the quoted price of a bond, right? It's in percentage terms, 90.5. Right? That means for every dollar, it's trading at 90.5%. Right? So meaning for a dollar, it is 0.905. And if the par value is $100, it's 90.5. Then if the price is 102.34 for a dollar, it's trading at 1.0275. And if the par value is 100, it is 102.75. Premium bonds, like what we discussed earlier, that is where the bond price is higher than the par value. The reason is interest rate on the bond is higher than the prevailing interest rates in the market. Okay, so the coupon rate is higher than the yield. Then it trades at a premium. So 5% coupon bond selling at par. If 5% coupon bond selling at par, 7% coupon bond is at a premium. Okay, see whether you understood that. If 5% coupon bond is selling at par. Right. So the coupon bond is a coupon bond, 5% coupon. It says it's selling at par. Now, if the coupon is 5% and it's selling at par, what do you think the yield is? What would be the yield? bond coupon is 5% and it's selling at par. So what would be the yield? If you understood what we discussed so far, you should be able to answer that. Yield is also 5. Very good. So yield is 5. Then if the coupon is, there's another coupon bond that's 7% coupon, and the yield is 5, 7% coupon bond should be trading at a premium, right? Then discount bonds. Bond is issued for less than its par value, or a bond currently trading below par. We are still into the terms of bonds, term to maturity. Like this is bond terminology, term to maturity. The time between when the bond is issued and when it matures, at which time the issuer must redeem the bond by paying the principal. Like when the bond matures, the issuer or the borrower must redeem it by paying the principal, or the amount of time between now and when a bond matures. Right? So you can buy a bond when it's first issued or in between. So the time period in concern is called the term to maturity. Either you buy it at the beginning, then you hold it until maturity, the entire duration of the bond, or if you buy it in between until the bond matures, it's called term to maturity. For example, a 4.5% 1st January 2020 bond issued on 1st January 2010 has a term to maturity of what? Of 10 years. If it was purchased originally, it has a term to maturity of 10 years. But if you had bought it in between, then you can calculate the number of days and months that remain. Okay, are we all clear up to now? Any questions? No questions? Right. Day count basis. Right. Now, if I may ask you a simple question, if you deposit 100 rupees in a 1-month FD at 10%, how much will you get when the FD matures? A 1-month FD of 100 rupees at a rate of 10%. How much will you get when it matures? Simple question. 100 rupee FD placed for 1 month at a rate of 10%. How much will you get when this FD matures? One month, not 1 year. Because interest rates are always expressed in annual terms. Okay, so Dinesh gets 100.83. Jaini, how much do you get? You're placing 100 bucks today at 10% for a month, right? I get 100.77. Dinesh gets 100.83, Jaini gets 100.083. So why 3 different answers? That's because I said 1 month. No, I didn't give you the number of days. And so Dinesh should have taken it as 31 days. Jaini, I don't know how many days. I took it as 28 days. I took it as the month of February. Right. So based on the number of days you take, you consider the answer you get will be different. Isn't it? If you take 28 days, then you get a different answer. 31, you get another answer. Then what if this was a leap year like last year? Then it would be 100 into 1 plus 10% into 29 over 366. Different. Right? So the numerator can change, denominator can change. In this case, I use the actual number of days over actual number of days for the year. This is called actual. Dinesh has taken 31 over actual number of days for the year. You can also use 30 over actual or 30 over 360. 30 over 360 is what is used in the US and in Europe. This is what is used in Sri Lanka. And that's called the day count basis. Day count basis. Or the interest basis. The basis of calculating coupon or yield interest. Governments of Sri Lanka bills are based on actual 364, right? Treasury bills on actual 364. Bonds actual. US Treasury is actual 360. So it's not 30, it is actual 360. There can also be 3360. Right? This is not US. US is actual 360 is US. Right. Then the price of a bond Now, if you buy a bond at a discount, let's say you buy the bond at the price of 99. In 10 years, when this bond matures, you get the face value, meaning you'll get 100. Right? So the price has gradually increased from 99 to 100. Then if you buy a bond at a premium, say 101, again, when this bond matures, price should drop to 100 because you get 100 at maturity. Okay. Now, in this case, it is a discount. Here you have a premium. Right? If it's a discount or a premium, the amount of the discount or the premium should gradually reduce as bond matures. That is called premium or discount amortization. Right? It's a drop in the premium on the discount as the bond approaches its maturity. Then bonds now don't have any script anymore. It's all scriptless, all electronic. And the last point we will leave for later. And let's stop at this. We will continue from where we stop next week. All right. So thank you very much. Have a safe week. I will see you all next week.